So the COT report is out, and we're wondering if the dollar suddenly becomes strong. From what I see here, it is quite clear, but I wonder what's going to happen when you look at other currencies to see if something else is better than this, and if we should still head into this week diving into buying more dollar or shorting the dollar. Without further ado, let's head into the analysis for the COT report this week. Okay, people. So the COT report is out, and we all know what goes down when it happens, right? We are going to be looking through every single currency in the market, the major currencies of the market, the 8 markets you know of. And right off the bat, we can see a lot of things happening on this place, a lot of things. I did a little bit of change to the dashboard in case you're a bit confused, but all in all, it's all cool. So let's start from the top. The leverage fund, as you all know, I specifically track the leverage fund because these guys, they are the ones that are majorly trading aggressively and momentum driven, which is something swing traders are all about. Let's take a look at it one after the other. So this is the last week's situation, and this is the total trades taken by the leverage fund in the year 2026. So year to date and last week. So what do we see in last week's data? Well, we first see that the Australian dollar and the British pound are still very positive for the leverage fund. The total number of longs compared to the total number of shorts says the story. We also see they're still shorting the BTC, that is the Bitcoin, in case you trade that. They are still shorting the CAD, heavily shorting the New Zealand dollar. I'm surprised at this because I think towards the end of the week, the New Zealand dollar suddenly gained like extreme strength. However, that doesn't really matter. Looking at the Japanese yen, they are heavily short on that zone. The euro against the British pound. Now, this is a very funny situation. I always see the euro against the British pound as a standalone entity compared to the euro and then the British pound. So if they are going long on British pound and going short on euro, obviously the euro against the British pound is usually always the middle ground between the both of them. And as you can see here, it is literally the middle ground between both of them. It is still short overall because the amount of shorts on the euro side is so much strong compared to that on the British side. All right. So this is the quick overview of the COT data for this week. But let's look at what they've been doing all year, right? The total number of contracts they've made and everything. And what do we witness here? Well, what we witness is surprisingly, even though this week they have like better euro stance in terms of bullishness compared to the Swiss franc, but down here we notice similar situation is what is happening. So this is their temperature this year. Their temperature has been long the Australian dollar, long the British pound, and then kind of, should I say, stay neutral on the euro, a little bit neutral on the dollar, a little bit neutral on the Swiss franc, and short every other thing. So that's their total trades in the whole year. Now, this doesn't on its own tell you everything. This doesn't tell you go out there and buy the US dollar because it's stronger than the New Zealand dollar. Nope, that's like terrible move if you do that. You need to not just understand what the data is, you also need to understand the changes in the data, like what is their actual trend? Are they adding every week? Or this number might be big today. What if by next week they drop so much order that this is now bearish? And then the upper week, they add so much order that it is now bullish again. So you get confused. What you want to understand is you want to understand what really happened. What did they reduce? Are they less confident by reducing their longs or increasing their shorts? Or are they more confident, but it's not showing up yet in the total number of, should I call it weights, in the weights of longs to short ratio or longs to total game ratio? Now, this is where we use the dashboard, or rather the table. A table is meant for us to see things like, for example, we have the Australian dollar right here. The Australian dollar, we have him standing at 66.6% of long orders out of all their orders. So this is actually the logic I use behind all my calculations. I don't just say they're long, they're short. I need to know to what degree long are they. And to get that degree, I simply say, what is the total number of long orders in every single order placed? So I look at the total order and then take out the long. If the long is making more than 50% of the order, obviously, it means that they are actually long this market. If the longs are making way less percentage than the total number of orders, like compared to the total number of orders, obviously, they're shorting that market. It's the same thing I use in across the entire dashboard in getting the weight I do. I don't just say, oh, the dollar has this, the pound has this, and it's all good. No, the dollar has this to this degree, the pound has this to this degree. The between the both of them, which is better in their degree stance, you get, and then you know which is actually better to sit on and which is better to take out of your place. Now, look at this, for example, right? We have a total leverage funds of 59,300 and a total leverage shorts of 29,617 orders or contracts on the Australian dollar from the leverage funds alone, giving them a net position of 29,683 orders. But this is where you need to really, really pay attention to. This is where you need to put your brains into. Yes, they are long. Yes, they are long. But look at the changes that happened. What is the changes actually saying? The changes is what tells you they are long and they are confident about the long, or they are long but they are not so confident as they used to be. Take a look at this situation. They have a negative 4,836 long contracts. That is, they reduced 4,000 long contracts, but they also reduced short contracts. However, they reduced 2,000 short contracts. This is telling you that it seems like their trust in the Australian dollar is beginning to dip. That's what you just need to understand here. If the long contracts are removed a lot more than they are removing short contracts, it means we are no longer trusting the stuff to keep going up as much as we used to trust it, even though we think it will still go up because we have like way more orders left in this same market than short orders. So that's basically what it is about. So their changes is basically saying, well, confidence drops. Let's go to Canadian dollar. The Canadian dollar, they are currently at 23.54%, which is not good. Well, basically, which is not long. So they are kind of like heavily short in this market. So the Canadian dollar, they added 1,700 long contracts and they reduced 3,351 short contracts. Oh, so that means they're actually going long in the Canadian dollar. So the confidence in the Canadian dollar is beginning to increase, but it has a long way to go. I mean, take a look at this: 124,000 plus short contracts and 38,000 long contracts. So they are beginning to improve their trust, but it's so slow. For the Swiss franc, similar situation. They are increasing their longs and increasing their shorts also, but the short is increasing in a very, very minute manner, making them well, they don't have a far place to go, so they might quickly catch up and become positive on the Swiss franc. Really good. For the euro, they are at 39%, 39.69%. You can see that the total net position is currently negative 45,000. The amount of long they took here is 14,000 down. So they reduced a lot of long contracts. And they also reduced short contracts. But the rate at which they reduced their long contracts is so heavy that the reduction in short contract is it's not noticeable. So therefore, they are short the euro and looking to short even harder. The British pound, well, they have more orders. They added more longs and more shorts. Okay, now this is quite tricky, right? However, this is what you pay attention to. They added much more long than they added much more shorts. That is what you should pay attention to the most. I'd love to always compare like 2 weeks together. So we'll see like the change last week, the change this week, probably. Maybe I'll do that some other time. Well, next thing we have the Japanese yen. The Japanese yen, what we have here is basically they are almost twice short. That means for every one long contract, they have almost two short contracts for it. And the recent change, well, whoa, okay, this is what you need to also pay attention to. They are getting scared of shorting the yen as it stands right now. You can see everything we've seen here has been 2,000, 1,300, 1,000. When it came down to the yen, guess what? They reduced a lot of short contracts. 27,000 short contracts on the funds, leverage funds end, meaning they have started to see a tendency that this yen is going to gain strength. And we know the BOJ has been threatening a lot, a whole lot. And they also reduced their long contract, but you can see how minute the reduction is. That is what I'm talking about here. So moving on, we have the New Zealand dollar against, sorry, I said against. I've always used to saying against because we've been doing the currency pair, comparison. But taking a look at what we're seeing right here, we have the New Zealand dollar having 18% of its contracts being long, which is basically their short this market. And what's the recent change? Well, they increased their short contract, meaning they are much more confident in shorting this market. And they also reduced their long contract, but they reduced 419. They increased short by 1,429. So there it is, clear and clean. They hope the New Zealand dollar goes even further lower. And then we look at the US dollar. Now, this is the last, the big guy, the guy everybody has their heads on, right? What they did last week is they ended up at 43% long contracts in total. And what this actually means is this: how they got here. They got here by taking out some long contracts, but taking out a lot more short contracts. So, in other words, there is a high tendency they believe this market is going to gain strength. That is the way it is. They have like much more belief that the market will gain than the market will lose strength. So I think you should be watching out for the US dollar to gain strength soon. And basically, I think I was looking at it this afternoon. Well, we have a resistance zone right here, support and resistance zone. And then we also have a demand zone down here. So there are two ways dollar could bounce off most likely. Either it starts running up this week by CPI data release. If the CPI data comes out, higher than expected, comes out high, above the 50%, right? Above 50. Or we're going to see a drop into this zone to then finally see that shoot up. But it all depends on those sets of news for next week, how they come out and how they go. We're going to go into the COT data history. And right here, we have the COT data history. Now, the thing is, I like to look at not just the leverage fund, but I also want to see what the asset managers are doing and the retail sentiment looks like it's doing. What the institutional traders, they are the thick blue line you see here. Thick blue line, very thick blue, this one. If you look at the Australian dollar, way back in December, they were heavily short. And then they went so much long, which we saw the Australian dollar really gain strength. And now they've gone so short on the same Australian dollar. The leverage funds are long this market, but they are drifting downwards also, if you've noticed. This light blue up here is the leverage funds. They are drifting downwards. They too are losing faith in these markets. It's not easy. I don't blame them. Moving on, we have the Canadian dollar. We see massive drops from the asset managers. You see the asset managers dropping their long contracts, heavily increasing their short contracts. You see, funny thing is, the amount of contracts the asset managers have been placing increased ever since June 9th. And it increased in the sense that they massively took out longs and placed it into shorts instead. So more like they reversed positions, which is a total, should I call it, it's kind of a contrast from what the leverage funds are doing. You can see the leverage funds, they increased their contract also, but they didn't increase their shorts as much as or as aggressively as the asset managers, making them, even though they are net short, but they are not heavily shorting as much as the asset managers do. The asset managers, they are strongly pushing this shit down, but like pushing it down, let's go down. Then we have the Swiss franc. The Swiss franc, comparison between the asset managers and leverage fund. Well, what we see here is increase in contract recently, heavily increasing the shorts. We also see similar things in the leverage fund. But the leverage funds are doing their increments in a very, very different manner. Increasing the contracts, but also increasing the long contracts alongside, and also increasing their long bias in this market. So I'd say they are doing the buy the dip movement. So they are buying the dip kind of movement against the asset managers in this case. Then we have the euro traders. Euro. Ooh, we all know how asset managers always love the euro, like it's one of the most stable economy to them. Same thing with the Swiss franc too, but you can see the asset managers in general, their total contracts added more. They keep adding so much long and so much short that it's not tilting so hard to the downside, but it is going to the downside. So recently, they've been the short contract seems to be increasing faster than the long contract is increasing over time, which is what we've been saying recently. So there's a downslope here. But for the leverage funds, it's a very clear downslope. These guys have been chopping it down heavily, every week, every single week. Then we have the British pound. I don't want to look at the euro against the British pound. The euro against the British pound is basically an average of both of them. So let's look at the British pound, and well, this economy slumped hard. In fact, it has been slumping hard when it comes to the asset managers, right? However, when it comes to the leverage funds, guys, these guys, uh, they just keep playing around with it. They have the same level of contracts, but you know, they increase the shorts, they increase the long. They reduce the shorts, they reduce the long. They've been doing that same ball game recently. So what does this mean? Nothing big, nothing different. It's just that they are not as confident in the long situation as much as they would be in some other cases, right? While for the asset managers, they are confidently short these markets. They are like, ain't no way, this thing is going down. You get like, they strongly believe in that downtrend. Moving on to the Japanese yen, we see the asset managers, whoa, okay, this is scary. In the recent 3 weeks, you can see all the way from this June 16th, seems like, yep, June 16th is the lowest sentiments they had recently. Ever since June 16th, they've slowly started piling up yen stance. You can see that pile up there for the asset managers, which is a good thing. But for the leverage funds, what did they do? Well, they kind of slowed down in their movement entirely. Like they literally slowed down heavily. They went long, went short, went long, went short, but major slowdowns. Meaning the scare for the yen to gain energy right now is not just on the charts, but is also in the actual heavy traders market right now. They are kind of, the BOJ can do something at any point in time now and destroy all of us. But the New Zealand dollar, there was a point in time this market was heavily strong, like seriously strong. Even though the contract was reducing, the amount of people who had long contracts, who had faith in the long contract back in 2025, there were a lot. Now, the amount of people that have faith in their short contracts are way, way, way more than the amount of people who have faith in a long stance on the New Zealand dollar. And you can see that heavy decline since the 2nd of June. Heavy decline, heavy decline. It's still in that down slope. Let's look at the leverage funds. Now, the leverage funds, confusion. You can see the asset managers, they are very, very specific about what they are doing. And mind you, these guys, they are moving money around anyways, but they are very specific in what they are doing. If they're moving down, it's for a while. If they're going up, it's for a while. They hardly have situations where they do this up today, down tomorrow. It's rare, very rare, right? But for the leverage funds, in the case of the New Zealand dollar, they've been up today, down tomorrow, up today, down tomorrow. However, among all their up today, down tomorrow, they are all not trusting this market. So it's basically short all through, even with their up to date, down tomorrow situation. Last but not least, we have the glory boy of the day, the US dollar. Now, for the US dollar economy, it's very tricky. This is where the situation is very, very tricky. This data always comes from the Chicago Mercantile. Is it Mercantile or Mercantile? Well, I don't know how to pronounce that name, but this is the name here, Chicago Mercantile Exchange, which to me, I think there is a bias. There is. I personally feel, I'm not saying this is something that's happening out there, but I personally feel there is a small bias to the US dollar. So, like, there's this small, because it's the US dollar thing for the asset managers. Unlike the leverage fund guys, these guys don't care if it's the US dollar or the pounds or whatever. They're doing their trades because there's money to be made here. That's the difference. And this is why I said you need to be careful when you follow the asset managers. The asset managers are not, they're not so true and true. They do trades because they do believe in something, but when it comes to the US dollar, they have this heavy, heavy. Yes, they've gone short from time to time. You can see it right here. They've gone short before. They've even gone short this year at the beginning of the year in March. They went heavily short. But the thing I'm saying here is, you notice how extremely long stance they are. Like their stance is so extreme to the long side. This is about what 95% of their trades contract is long the dollar, which is more like if I should say, I would say it's more like, not to be political or anything, but I'm not trying to do politics or whatever, but I'm just trying to say that it seems like they are just trying to make sure the dollar keeps a heavy strength. However, mind you, this is something you also need to notice. These guys trade for a long time, so don't forget that situation. You see the long orders you see coming in, or the short orders you see coming in long ago, they are going to stay for months before it's removed from the market. So when you see contracts actually dropping, it means that these orders have stayed for quite some time and are now leaving the book. Compared to the leverage funds, these guys could place orders today, take it out in the next 1 week or 2 weeks. Again, these guys have they are portfolio managers, they are CTAs, they are certified trading advisors. These guys are people who they have somebody who gave them money to trade, so therefore they have to report either weekly, monthly, or probably quarterly or bi-yearly, but they have to report that they are making profits or they are losing that person's cash. So they will tend to take trades like you and I. Not really completely like you and I that would dive into the 1 minute. No, but they will tend to take trades like you and I in the sense that they will take trades, and if they see it going against them, they do not wait for major unnecessary economic catastrophe before they will change it. No, they will take that trade out because it's not working. That is why you see them fluctuating hard. Anyways, that's it for today. We have the COT report analyzed, every single thing you need to see regarding the COT report between the year 2025 until date, and also the changes they have made in their different contract placements this last week. I hope it gives you a clarity of what to pay more attention to, what to pay less attention to. I know the US dollar has like major divergence right here, kind of confusing. The asset managers are heavily long. The leverage funds are kind of neutral on the stance, making you feel like you don't know what to do. Well, I'll tell you one thing for a fact. The CPI report this week is going to determine a lot. And then by the time you see next week data, you will notice something very, very sharp. Either the leverage funds are going to be diving extreme low, or they are finally going to go either neutral or positive once those data comes out. But until then, I remain Chuku Nicholas with you guys. See you guys in the next one, where we'll be talking about any other thing that really matters to the market. Peace.